Hi everyone! Last week the benchmark stock indices showed explosive growth. The NASDAQ was the biggest gainer, jumping to the highs of April 2022. There are no drivers for a further rally. Uncertainty of the debt ceiling persists. A little more than a week remains before the default. So far, talks between the Biden administration and Congress have been fruitless. Interestingly, both parties have mentioned positive shifts in negotiations. However, market participants are cautious. Many assets are now trapped in a narrow range. This week, the economic calendar is rich in events. The US PCE price index, the second estimate of GDP, durable goods orders, the services and manufacturing PMI indices, as well as new and pending home sales are due. Talks over the debt ceiling will be in the spotlight. Speculators are also looking forward to the release of the Fed meeting minutes and new speeches of Fed officials. For the second week in a row, market sentiment has been mainly shaped by the news on the debt ceiling. Fed policymakers have also made lots of interesting comments. Watch our video review and learn the latest market news. Let's start. The lack of progress in negotiations on the debt ceiling forced investors to flee from risk assets. Last Friday, there was a correction in the equity market. As a result, stocks closed mixed on Monday. There is still a chance that the parties will reach an agreement and prevent default. Some analysts believe that it might happen even before June 1st. Stock indices ended Friday's session as well as Monday's trading with a fall. Yet their losses were small, especially given the rally before a downward correction. The main stock indices closed with a drop of 0.3%. It means that speculators still hope for a deal between Democrats and Republicans. On Monday, President Joe Biden and House Speaker Kevin McCarthy resumed talks. McCarthy said that negotiations are on the right track. "I believe we can still get there," the lawmaker noted. However, Treasury Secretary Janet Yellen again warned that the government could run out of money by June 1st. As the standstill of the debt ceiling persists, the first ever default in the United States looks real. Yellen added that on Friday the Treasury Department had $60 billion left. As for the movements of the key indices, the Dow logged the smallest weekly gain, rising by 0.7%. This growth was mainly attributed to a jump in the middle of the week. Market sentiment turned sour on Friday and the Dow Jones rolled back by 100 points. Investors are also pinning their hopes on monetary easing. This scenario is extremely favorable for stocks. At the June meeting, the Fed may hold interest rates steady. Some Fed policymakers have already hinted at such a possibility. However, this week, Fed officials made a new contradictory comments. Neil Kashkari said that it was a close call whether he would vote to hike interest rates or pause the tightening cycle next month. However, James Bullard supposes that the regulator may still need to raise its benchmark interest rate by another half point this year. Last Friday, Fed Chair Jerome Powell said that inflation remains above the central bank's target, but new rate increases may be unnecessary due to the banking crisis. Therefore, investors are now betting that the central bank could end its most aggressive tightening cycle in history next month. Some analysts suggest that the pause in June may not mean the end of monetary tightening. At least one rate increase may occur before the end of the year. The Fed also takes into account incoming data. Sometimes fresh figures may bring unpleasant surprises. The S&P 500 index climbed by 1.8% last week, notching the best performance since March. On Friday and Monday, it retreated slightly, but this move was insignificant given such an impressive rally. Investors are now puzzled about what trend the index will pick. It has broken through the pivot level of 4,200. It may either hold its rise or start a correction before hitting the next target level. Over the past 2 years, the S&P has stopped a rally near the 4,200. Many times this level was a kind of ceiling. It halted its steady rise in April-June 2021 at this level. This was a key support level in March and May 2022 and resistance of the past 12 months. Last Friday, bulls were less willing to open new positions at this level. The index needs strong drivers to finally break through this level. At the moment, the lack of progress in the negotiations of the debt ceiling forced speculators to lock in profits. Notably, the S&P does not look overbought after last week's jump. Technical indicators signal the likelihood of a correction near 4,100. Such a move does not mean the end of the medium-term uptrend. However, in the worst-case scenario, the index is likely to dive to 4,000. This is a psychologically important level. The index could even approach 3,800 if new economic reports show a sharp contraction in the economy. What happens if the debt ceiling is not raised? The S&P could shed more than 10% as investors are reassessing the economic prospects as well as current risks. In case of a drop, the index will be able to recoup losses if lawmakers come to an agreement. A steeper fall, for example, by 20%, is unlikely. The NASDAQ 100 climbed by 3%, which was the biggest weekly gain in 2 months. Strong earnings reports of tech giants overshadowed concerns about the debt ceiling and stubbornly high inflation. The NASDAQ was able to recoup more than half of the losses this year. Its growth was mainly driven by Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta Platforms, and Tesla. These stocks have risen at least by 30% since January. At the same time, Nvidia and Meta shares doubled their price. Without their contribution, the NASDAQ 126% advance this year would shrink to just 4.1%. As for the further trajectory of the index, one should pay attention to its reversal on the daily charts last Friday. This happened immediately after touching the overbought level. The index began a rally amid worries of the debt ceiling. However, investors were more impressed by the financial performance of tech firms. For a long period of time, they have been unable to recover due to monetary tightening. However, they posted upbeat results in the earnings season. The rally is coming to an end. Profit taking on the NASDAQ may trigger a correction in the stock market. As the default risks are high, it will be extremely difficult for stock indices to revive. According to the Bloomberg survey, nearly 60% of respondents said the risks of default are bigger this time than in 2011. JP Morgan warned that stocks could see a dramatic sell-off if lawmakers cannot reach a debt ceiling deal. Political rivalry of the debt ceiling deal exacerbates the threat of recession. In the summer of 2011, Congress eventually reached a deal just a few days before the date of a potential default. At that time, long-term bonds were in high demand, growing by almost 30% in the second half of the year. Apple shares fell about 1% after Loop Capital downgraded its stock rating to hold from buy. Meta shares also shed losses after the platform was fined by European regulators. Foot Locker stock decreased by 27.1% after disappointing quarterly results. Conversely, Farfetch jumped by 14.7% after an unexpected increase in revenue in the first quarter. Zoom Video, Lowe's and Dick's Sporting Goods are scheduled to unveil their earnings reports this week. Nvidia has become the de facto leader of this year's market rally. The chip market cap is estimated at $770 billion, so its shares are likely to hit new highs. Given that Nvidia is one of the leading companies that dominates the whole landscape, its prospects are bright. Nvidia is working with the UK's University of Bristol to build a new supercomputer using a new Nvidia chip that would compete with Intel Corporation and Advanced Micro Devices Incorporates. That is all for now. Subscribe to our channel and keep your finger on the pulse. See you.